Welcome to our comprehensive guide on property, plant, and equipment, or PPE, under IAS16. In this video, we'll break down what PPE means in the context of financial reporting, why it's important, and how the revaluation model works. Whether you're a student, a professional, or just curious about accounting standards, this series will help you understand the essentials. We'll start by defining PPE, then move on to recognition, measurement, depreciation, and the all-important revaluation and impairment processes. By the end, you'll know how to present and disclose PPE in financial statements and understand the difference between PPE and investment property. Let's get started by exploring what PPE really is. Property, plant, and equipment, or PPE, are tangible assets held for use in the production or supply of goods and services, for rental to others, or for administrative purposes. These assets are expected to be used for more than one period. Examples include land, buildings, machinery, vehicles, and office equipment. Initial recognition of PPE occurs when it is probable that future economic benefits will flow to the entity, and the cost can be measured reliably. At this stage, assets are measured at cost, which includes purchase price, directly attributable costs, and any dismantling or restoration costs. Understanding this foundation is crucial before we move on to how PPE is measured after initial recognition. After initial recognition, entities must choose an accounting policy for subsequent measurement of PPE, the cost model or the revaluation model. The cost model keeps assets at cost less accumulated depreciation and impairment. The revaluation model, however, allows assets to be carried at a revalued amount, being fair value at the date of revaluation, less subsequent depreciation and impairment. This choice must be applied consistently to an entire class of assets, such as all land or all buildings. The decision impacts how changes in asset values are reflected in the financial statements, so it's important to understand both approaches before selecting a policy. Revaluation model is a key feature of IAS16. Under this model, assets are revalued to their fair value at the date of revaluation, less any subsequent accumulated depreciation and impairment. Fair value is the price that would be received to sell an asset in an orderly transaction between market participants. For land and buildings, market prices are often available, while plant and equipment may require professional appraisals. It's important to note that if one item in a class is revalued, all items in that class must be revalued to ensure consistency and comparability. Let's see how this process works in practice. When revaluing PPE, the revaluation amount is the difference between the asset's fair value and its carrying amount at the revaluation date. If fair value exceeds carrying amount, it's a revaluation increase. If it's less, it's a decrease. Increases are recognized in other comprehensive income, OCI, and accumulated in equity as a revaluation surplus, unless revering a previous decrease recognized in profit or loss. Decreases are recognized in OCI to the extent of any existing surplus, with any excess taken to profit or loss. This ensures that gains and losses are appropriately reflected in financial statements. Let's look at a practical example next. Let's walk through an example. Suppose land was purchased for R2000000. After 2 years, it's revalued to R260000, resulting in a R60000 revaluation increase, which is credited to the revaluation surplus in equity. Later, if the fair value drops to R240000, the R2000 decrease is first deducted from the revaluation surplus. If the value falls further, say to R180000, the first R6000 decrease is taken from the surplus, and the remaining R2000 is recognized in profit or loss. This example illustrates how revaluation gains and losses flow through OCI and profit or loss, ensuring accurate reporting. Now consider the opposite scenario. A revaluation decrease followed by an increase. If land initially valued at R200000 is revalued down to R15000, the R5000 loss is recognized in profit or loss. 2 years later, the fair value rises to R23000. The R8000 increase is split. R5000 reverses the previous loss in profit or loss, and the remaining R3000 is credited to the revaluation surplus in OCI. This approach ensures that previous losses are reversed before new gains are recognized in equity, maintaining a fair and transparent accounting process. It's important to distinguish between revaluation decreases and impairment losses. Revaluation adjusts the carrying amount to fair value under the revaluation model. If, after revaluation, the asset's recoverable amount is less than its carrying amount, an impairment loss is recognized. For example, if land's fair value is R960000, but its value in use is R98000, no impairment is needed. However, if disposal costs reduce recoverable amount below carrying value, an impairment loss is recognized. Understanding this distinction ensures accurate reporting and compliance with both IAS16 and IAS36. Proper disclosure of PPE is essential for transparency. Financial statements must show the measurement basis, depreciation methods, useful lives, gross and net carrying amounts, and a reconciliation of movements during the year. This includes additions, disposals, depreciation, impairments, and revaluations. The statement of financial position presents the carrying amount of PPE, while the statement of profit or loss and OCI shows depreciation, impairment, and revaluation effects. The statement of changes in equity reflects movements in revaluation surplus. Clear disclosure helps users understand the company's asset management and financial health. Finally, let's briefly touch on investment property, which is covered under IAS 40. Investment property is land or buildings held to earn rentals or for capital appreciation, not for use in production or administration. Entities can choose the fair value or cost model for subsequent measurement. If the cost model is chosen, IAS 16 principles apply. It's important to distinguish between PPE and investment property, as the accounting and disclosure requirements differ. This distinction ensures that financial statements accurately reflect the nature and use of the company's assets.